Hey everyone, and welcome back to another video for today. So I've been getting a lot of comments and questions, whether it's during the live stream or in the comment section about, oh, is stock X still a good buy? Does it make sense to buy this stock at the current price? Because, well, let's face it, even if today, as you can see, we've seen a lot of red across the board, right? Even if that's the case, even if certain stocks have come down from the recent highs, do not forget where the market is at the moment. We are near all-time highs. Plenty of stocks have doubled, if not tripled, since the lows in April. Some of the stocks are actually still up, well, over 50% or 100% over the past month. So having a little pullback, having certain names, right, certain popular names that popped 50%, 60% in a matter of a couple of days or weeks in June, pull back 10, 15, maybe 20% over the past couple of days is completely normal, okay? Nothing changed with the thesis, okay? Nothing changed with the business over the past couple of days. Unless of course, you are in Centene or something like that and management basically pulled guidance because XYZ happened. Okay, that's a different case. And yes, then we've seen companies like, well, stocks like Oscar come down quite a lot. But don't forget that Oscar also had a huge run-up in just a week or so. And so now we're pulling back. Of course, it doesn't help the stock when day after day after day, we've got analysts coming out with price target downgrades. It's quite interesting that they waited until the stock price comes down for them to actually downgrade the stock and not when the stock was going up. Okay, interesting how that works out. But let's talk a little bit about certain companies here. I also touch on the Fintech crash, let's say, or pullback for today, because it seems like everything went fine at PayPal and all of that, Affirm, Block. Suddenly they all went down. So let's talk a little bit about that. I'll touch, of course, on Google, because Google closed the week at $180. So congrats to all of us Google shareholders. AMD was up 1.5% on Friday, closing the week at $146, $237 billion in market cap. So another great week for us advanced money destroyer turned into another money doubler. So we're going to talk about all of that in this video. I am going to talk more about my moves and my potential moves more in depth in this Sunday portfolio video. So stay tuned for that. If you're new here, hit the subscribe button. We really appreciate that. We're well on our way to reach 100,000 subscribers. So if you're new here, hit that subscribe button. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so as you can see, on Friday, PayPal fell 5.73%. We're back to $71, a market cap of under $70 billion. Here on the right, you can see all the other stocks on the watch list here that have come down, well, more than 4%. We finally have a very attractive pullback for Nebus here, back under $45. We see popular names, well, in the Bitcoin mining space like Iron, down 4.7% here as well. Does that suddenly make these companies bad companies? No, it just means that you should never chase these types of things. And me personally, when I go with those smaller bets for the potential multi-baggers, right, it doesn't change my mind in a matter of days, right? If I think that these things, these smaller players, right, the Iron, the Cypher Mining and Applied Digitals, right, the really small players that could be potential multi-baggers in the future, right? I don't care if I miss a 10% here, a 10% there, if I'm really, really going for that 5, 10x in the future, right? If you really want to time the market to get a 10% difference, but you risk missing a 10x, you're going to regret this mistake for a long, long time. Now, going back here to the fintech side of things. So on Friday, a report came out that said JPMorgan tells fintechs they have to pay up for customer data. And by the way, I don't know if you noticed this, but this is Google search, but Google AI mode. Now you might say, Neil, how can you have access to AI mode? You're in Europe. Well, the magic of VPNs, of course. And so I'm trying this out. And to be honest, I mean, you're going to ask me, how isn't this like Gemini? No, this is like search, but conversational search. So it's just like going on Google search, but now you can have conversations with it, right? So I asked it about this report. what does it mean? Why is PayPal stock down? And it gives me the answer, and I can continue the conversation. I can continue my search journey. So then I ask, don't PayPal and JPMorgan have a partnership? And I got an answer there. And then we can continue the conversation, but it is Google search. With Gemini, it's more like an AI assistant where you have, well, just conversations. Of course, it can search the web as well. But this here AI mode is basically a glorified AI overview. So what happened? Well, reports suggest that JPMorgan Chase is now requiring fintech companies to pay for access to customer data, potentially impacting fintech business models that rely on such data. So what could be the potential implications for PayPal and the fintech industry? Well, increased costs for accessing customer data could affect PayPal's profitability and potentially lead to service adjustments. The broader fintech industry may face similar challenges, potentially leading to shifts in business strategies and cost structures. Fintech companies might need to reevaluate data acquisition and user strategies, potentially impacting innovation and competition. Then I asked it, don't PayPal and JPMorgan have a partnership? And yes, they do have a strategic relationship, and a recent expansion of their partnership was announced back here in February 2025. So the first partnership was initiated in 2017, focused on enhancing payments online, in-app, and in stores. Then in 2025, the early 2025, they expanded the relationship with JPMorgan Payments, planning to offer Fastlane by PayPal to its merchant clients in the UK and Europe. This expansion also involves PayPal expanding merchant acquiring in the UK and European markets using JPMorgan Payments' commerce platform. Both companies aim to scale innovation and redefine the global digital commerce experience. It's important to note that despite these partnerships, JPMorgan Chase and PayPal may still compete in other areas, as reported by the Wall Street Journal in July 2017. Well, that was a while ago, and Alex Chriss wasn't there, and PayPal wasn't the company it is today. For instance, JPMorgan Chase connected its banking apps to Zelle, a money transfer service that rivals PayPal Venmo. So right now, okay, in my opinion, this is again an overreaction by the market, because yes, it's true that despite PayPal having an amazing ecosystem and owning a lot of that data inside the PayPal ecosystem, and despite users, let's say, linking their bank to PayPal once, okay, that's one step. But every time you want to withdraw, every time you make a payment and somehow it is connected with your bank, this is the type of data that PayPal still needs to get from your bank. And maybe that's what we're talking about right here. Now, again, I don't know how much more expensive these things will be, or what type of partnerships or relationships PayPal will have with JPMorgan with regards to this. Remains to be seen. But you know me, you know my thoughts on PayPal here at $71, $70 billion in market cap. It is extremely, extremely undervalued. And yes, it's PayPal. Yes, we are bag holders, although I'm still in the green with regards to PayPal. But it's true that the majority of other fintech players have gone up, whereas PayPal is not going up. But I still think that the next earnings report and guidance and earnings call will be another catalyst for the stock, because the market will realize that, oh, actually, we are mispricing this stock completely. Moving on to some macro news real quick. We here have the receipts, outlays, and surplus for June 2025. So this is, I believe, the first surplus since 2005, and that's a surplus of $27 billion. Now, what's interesting here, if you look at the total receipts, $236 billion come from individual income taxes, okay? And a large part of that is just paid by the top 1% and the top 10%, just so we are clear. On the outlay side of things, net interest right now sits at $84 billion. That's more than health, that's more than national defense, that's more than Medicare. So yeah, this is going to be quite interesting. There was also a report that came out, and this is something that Pulti tweeted out and said that, oh, there are some rumors that Fed Chair Jerome Powell might be resigning soon because of the pressure that has been put on him. Again, I might not be Jerome Powell's biggest friend or biggest fan. I might think that, yes, we should have cut, or they should have cut rates already. I'm still expecting 2 rate cuts this year, so that doesn't change. But I don't like the fact that an administration and or someone like Bill Pulte is putting pressure on what should be a body that is independent. Okay, I think yes, the Fed was late before. I think the Fed is late again right now, but rate cuts will happen. Okay, they might not happen right now. They will probably happen in September, and we're going to get our 2 rate cuts this year. Remember, markets are at all-time highs or close to all-time highs, right? Gold is up, Bitcoin is up, stocks are up, and we are not in an extreme rate cutting cycle. Think about that. Right? I keep repeating the same thing time and time again. The longer the rate cutting cycle, the longer you can stretch a bull market, especially if you cut because, well, the economy is just doing well and you think that interest rates can come down without, well, inflation going out of control, which is what we are currently experiencing. Of course, tariff impacts could be felt in the next couple of quarters. We might not be feeling it right now. We might be feeling it in the future. Might also never happen. Okay? Just so we're clear, cutting interest rates will, of course, make sure that this bull market can go on and on and on. Moving on to some other names, and I'll go over some popular names because these were the recurring questions and comments that I got over the past couple of days. So here we look at Oscar, for example. And as you can see, Oscar is back to prices not seen since, well, a month ago, right? Since mid-June. This is on the weekly, so you see that big green candle followed by a smaller one and then 2 red candles, which brings us back to these prices just under $15, which also means that we are under the 200-day moving average. RSI is pretty neutral here on the weekly. Did the business change in the past couple of weeks? No, the business did not change. Yes, the big beautiful bill did pass, and we did talk about that. The major effect, right, the big impact will be felt by 2034 if nothing changes. Okay, the business is not destroyed. ACA is not destroyed, it's not completely removed, nothing like that. Now, looking at the state of the company, right, the business, market cap, we're actually a bit closer to $3.5 billion right now in market cap, PE 34 times, trailing forward one 35 times or so. But if you look at, well, the expected growth 2 years out, EPS 225%, right? So when people are saying, oh, United Health, for example, comparing to United Health right now on a PE basis doesn't make much sense because, well, Oscar One is a much smaller company, younger company, and especially younger in its profitable journey, right? Then, if you look at cash, this is a company worth less than $4 billion, and yet it has $2.24 billion in cash, okay? Almost its whole market cap in cash. And I think if you take cash and cash equivalents and all of that together, you get quite close to the market cap of that company. Now, again, yes, it's true that maybe these growth projections right now for revenue are not realistic because of the, well, expiring subsidies or potential expiring subsidies later this year and changes because of the big beautiful bill, then this might not be realistic. But currently, as long as we do not hear anything from management, big changes for, well, guidance, whether it's long-term or mid-term guidance, then I don't see the reason to panic here. Also, if we look at what the business is expected to do, this is revenue for the next coming fiscal years, and this is EPS. EPS is expected to be 70 cents for fiscal 25, then $1.10 for fiscal 26, and then $1.70. Currently, those are the expectations, $1.70 in fiscal 2027. So you're paying less than 10 times fiscal 27 earnings for a company that is growing earnings or expected to grow earnings this quickly. Now, let's say you want a margin of safety here. Even if you want your margin of safety, it's still, in my opinion, worth the risk reward here. And so, no, okay, the stock is down. Yes, of course, if you bought at $22, right? There might be a reason why you bought at $22. And I hope it's not because of FOMO and hype. Because if that's the case, then tough luck. But if you bought it, if you really liked the stock and the company at $22, then you should definitely love it under $15. Moving on to another stock, another popular company here, a company where you know, right? For a long time, oh, SoFi, what a joke of a stock. Anthony Noto, what a joke of a CEO, because the stock did not go up despite the business doing everything it should be doing and then some. And now, of course, we are getting rewarded. And for those people that don't believe that, oh, big freaking deal, the stock went from $14 to $20 in the last couple of months. No, the stock is up 215% over the past 12 months. Okay? If that's not good enough for you, then maybe Vegas is the better play. Okay, right now, I've seen time and time again some questions. Oh, is it the right time to buy SoFi at the moment? Is it risky? Is it not risky? If you are purely buying SoFi because you like the business, then that's fine. But you should expect a pullback because, like I said, the stock has gone up tremendously. I mean, year to date, we're now up 51%, and over the past month alone, we're up over 40%. So yes, don't be the one that is chasing. You can open a position and then allocate accordingly if it drops. Because me personally, I'm not selling any single share of SoFi because I do truly believe that this company will be worth more than $23 billion in the future. Do I think that we're never going to go back down? No, of course, we can go back down, and we probably will go back down because not everything goes up in a straight line. I mean, if we look at the stock right now on the weekly we are overbought. And if I look at the daily, we're probably even more overbought. Yeah, look at this. Look at how high we're at right now, RSI wise. On the daily, the stock has been on a tear recently. So yes, don't be the one that is chasing, because I know this might be, again, like Oscar. You buy here, oh, great company, great future, this stock can only go up. And then we do drop a little bit, maybe even below $20. And suddenly, oh, I'm down, I got wrecked on SoFi. You have to know what you own, okay? You have to know what you own. Just like most of us knew what we owned at these prices right here, knew that this company is doing very, very well, and eventually we will be rewarded, right? We knew that we owned a great business at $6, $7, $8, $9, $10, and so we're not surprised to see SoFi here at a 3-year high. We're not surprised. Are we celebrating? Yeah, probably a little bit celebrating right now, but this is not the end game. Moving on to AMD, also a very popular name, a very, very good company here as well. And contrary to Oscar, which got downgrades, AMD is suddenly getting price target upgrades, which is why we're seeing the stock, especially in the last couple of days, go up and up and up, although it does seem like we might form here a double top here at around $146 or so. And so here again with AMD, as you can see, since the lows of April, the stock is up 90%. Of course, we've got way more information since then, and we know that the company is doing quite well. Can we experience a pullback? Of course, we can experience a pullback. Am I chasing AMD stock here? No, because I've been buying AMD stock since 110, under 100, at 100, and so I am not in a chasing mood right now. Do I think that AMD in the future will be worth more than, $230 billion or so? Yes, I do think so. I do think that if they continue to execute well, I think they will be worth way more than what they are today. So you might say, oh, so why don't you buy right now? Again, I already have a position. I don't have to chase. I have the luxury of waiting. And then buy whenever I feel comfortable buying or adding more. It's the same with Nebus, right? If we go and look at Nebus here really quick, Nebus, of course, has had an amazing run. From the lows here in April, basically more than doubled. Okay, amazing run. And yes, more recently, just like with CoreWeave, for example, although CoreWeave is up 4x or was up 4x since the bottom, here with Nebus, for example, we can see that the stock has gone up quite a lot. And more recently, the stock is now down around, let's call it 19-20% or so. But with Nebus, since that position for me personally is not as established as an AMD, for example, I am already starting to accumulate a little bit more already at these prices. And if we go near that 200-day moving average, which is closer to $40, then I will be accumulating more and more. Market cap wise, I still like the opportunity here around $10-11 billion or so. So I continue to accumulate because this is, again, in my opinion, an incredible company with great management, and the growth opportunities here are massive. Touching real quick on new holdings and maybe also Mercado Libre, although the explanation will be the same. Okay, we got the 50% tariff on Brazil. By the way, for those that don't know, Brazil doesn't really export that much. Okay, so you get a 50% tariff on a company that doesn't even export that much, where the US does have a surplus. And then you see companies like Nu and Mercado Libre get impacted by that. Nu is a fintech company, so tariff-wise, I don't know how big of an impact that will be, if any. Mercado Libre operates in Latin America. Okay, they don't operate in the United States. So here again, okay, maybe some of the things might come from the United States and stuff like that. Okay, but all in all, I find it quite ridiculous, and it's just the market and the algos doing their own thing. I still view both of those companies as world-class companies. I only own Mercado Libre, but I love Nu as a business. Great management, great business, and especially a great future. So I just wanted to say those things because I know some of you own both companies or just Nu. I just wanted to make sure that you understand my feeling around those two companies. Lastly, it won't be a video without me talking about Google here. So Google, as you can see, Google Alphabet is back at $180. It's a price where previously we have seen some rejections back in June and end of June as well. We were at 180. We couldn't hold that price. Let's see what happens. Let's see what happens with that. But slowly but surely, we are making higher lows, and it does seem like the narrative around Google and its search business is changing for the good. I'm saying that wait until the earnings report and you're going to see a huge narrative shift positively on a Google stock. I mean, 20 times earnings here for a business like that, to me, no brainer, of course. And I actually have a question to you if you're still watching the video. NVIDIA is the first $4 trillion company right now. I'm pretty sure that Microsoft will be the second one since they are the closest. But my question will be, who follows NVIDIA and Microsoft? Would it be Alphabet? Would it be Apple? Would it be Meta? Who becomes the third $4 trillion company? And maybe another question here is, when do you think Alphabet will reach $3 trillion? Do you think that can still happen in 2025, or that will only happen in 2026, or maybe never? Maybe never. Let me know down in the comment section below. And so all in all, to conclude, and yes, by the way, this is still the year-to-date performance across the board. Just so you know, a couple of Magnificent 7 companies are still in the red. Apple is down 15%, Alphabet is down 5%, 5.5%, Tesla down 20% year-to-date. So yes, concentration risk and all of that, I don't think so. And again, I don't think we are anywhere near 2021, for example. And so, yeah, some stocks keep dropping. It feels like they keep dropping because they've been down a couple of days. And maybe you were in a chasing mood and you bought the top or close to the top and now you're down in the last couple of days. But zoom out a little bit, will you? Because most of the companies, as you can see, have performed extremely well already. And we're now, of course, in the second half of 2025. But for the first half, most of the stocks have done extremely well, especially after that huge drop back in early April. So yes, it might seem like the last couple of days have been a struggle, let's say, for some stocks. But come on, we are still having an amazing year. And actually, we've been having an amazing couple of years now since 2023. So don't complain. Focus on, the long-term future and health of the businesses that you own. Don't chase. And if you're in a chasing mood, just know that you can, yes, go down 10, 20% or so, just like that. Well, make sure that those chase and those YOLO bets are just 1% or maybe even under 1% of your portfolio, so you don't get hit that much. That's all. Pretty simple. Keep it simple. Anyways, that's all I've got for you right now. Do share your thoughts down in the comment section below. Like, subscribe, all of that, and I'll see you all in the next one. Bye-bye.